Jeremy, if you're right and we're on the cusp of the bursting of an epic bubble, is now the time to, as they say, sell everything?
I suspect selling everything would work out just.
You believe that the bull market that started in March of 2009, the longest bull market in history, has matured into a speculative fever of rare proportions. In your words, a fully fledged epic bubble. Tell me more.
It would be surprising if you could have one that long that didn't end up with animal spirits beginning to freak out a bit, and this one has. Normally it takes a nearly perfect economy and friendly Fed behavior, but this one has managed to do it with a somewhat wounded economy on a global basis. And to compensate for that, we've had even more spectacular Fed friendliness and government friendliness. So we've had, for once, the joining of fiscal spending with the Fed's behavior and the usual moral hazard that has been going on since Greenspan arrived in the 90s. And the result of this is the confidence has risen and risen until finally people are reaching for the greatest demonstration of confidence they have had in their investment career. They're borrowing more money to throw it into the market. Their belief in the market is profound. The common wisdom is that with the Fed on your side, how can you lose? When they first said that back in Greenspan, there were a few doubters. When they said it with Bernanke, there were less doubters, but some. And now finally, there appear to be almost no doubters at all. The belief is more or less complete that all it takes is the Fed on your side and stocks will rise forever.
What are some of the signs we'll all look at with the clarity of hindsight and say, of course it was a bubble?
If you want crazy ones, and you need crazy, by the way, that's the best timing for a bubble top, is crazy behavior. You look at the over-the-counter trading. I was a big over-the-counter trader in a speculative bubble of 1969. I'd almost forgotten there was a over-the-counter. But last February, it traded about 80 million shares for the month. And it worked its way steadily through the year until November was about 380. So it had gone up 4 times. And then in December, it went to 1.15 trillion shares for the month. Having tripled, it then tripled again in the single month of December. I can't tell you what it's going to be in January, but these are spectacular performances. My own stock in QuantumScape, it came into the market at 10 and shot up to 130. At 130, it was bigger than General Motors or Panasonic. And this is a brilliant company, but it has no trouble admitting that it won't be producing any batteries for 4 years. So no sales, no profits, and bigger than GM. There is nothing like that in 1929, nothing of that scale, nothing like that in 2000. The Ciscos of the world were pretty serious companies, but they didn't get to this level. 1929, of course, ran into the Great Depression and global trade problems. So you really just want to look at the first leg down, which was big enough. The analogy is much better with 2000. In 2000, it went down 50%. And the reason it only went down 50 and bounced back relatively quickly was because the Fed came charging in to the rescue. And you can have a lot of rescues when you start at a 16% long government bond in 1982. You can have a bull market as you go down from 16 to 12, and another bull market from 12 to 8, and another bull market from 8 to 4. But now you're down at 2.5 or whatever. You have to realize that most of the easy pickings of saving the game by ramping rates down is behind us. At the lowest rates in history, you don't have a lot in the bank to throw on the table, do you?
No. At least
it doesn't appear
going by conventional monetary theory, no.
That's right. And the idea that, fundamentals, the real world doesn't count, all you need is money to generate real wealth, I think most people can feel is an illusion. You can imagine a situation where you had a much more serious virus, the economy really was on its knees, and the Fed would be doing everything it could. Would that be enough to save the system? In the end, the system is about the number of people working, the amount of capital spending, the quality of education of your workforce. That's the real world. We're talking about the paper world, and there's just so much blood you can get out of that.
Would a bubble have formed absent the COVID-19 pandemic?
It's the COVID brought in spectacular excesses on the part of the Fed and the government writing checks. And I say excesses, perhaps it was necessary, but in any case, it was unprecedented and the combination was very powerful. Without COVID, we cannot know. The market had resisted opportunities to bubble earlier in this 11-year cycle. It looked like it was getting pretty close about 3 years ago, and then it just kind of fizzled away. The confidence dissipated, the market had a decline. And those bull markets can go on forever, and you don't know how long and you don't know how high they can go. The back of every bear's mind must surely be Japan. Japan in 1989 managed to get to 65 times earnings. It had never previously gone over 25 until that cycle. So that is the thing that makes the bears wake up in the middle of the night sweating. So you just don't know how long and how high a market can go if you avoid the burst of euphoria. It's the burst of euphoria that typically brings these things to an end. And we are seeing it all around us today.
As you've noted, just because stocks are overpriced, it doesn't mean that a bubble, if we're in one, is necessarily about to pop. What is to stop valuations from climbing even higher? For years, possibly.
Put it this way. When you have reached this level of obvious super enthusiasm, the bubble has always, without exception, broken in the next few months, not a few years. It's always. You can't maintain this level of near ecstasy. It can't be done because you've put in your last dollar. You are all in. What are you supposed to do beyond that point? You can't borrow any more money. You can't take any more risk. In fact, you know in your heart of hearts, you have never taken this level of risk and you never thought you would. It's just that this opportunity is so exceptional. This is going to be your once in a lifetime. And how do you keep that level of enthusiasm going indefinitely?
What if it's not your money? What if it's the Fed's money? What if it's the Treasury's money?
Yeah, no, that of course is a very good point. And you can never call a bubble to a few weeks or even a few months. And if the government is going to write unprecedentedly large checks to some of the players in the market, then indeed their all-in position can expand one last desperate notch. And the sad truth of a lot of the quote stimulus is that it didn't increase capital spending. It didn't increase much in the way of real production, but it flowed a lot of it eventually into the market one way or the other. And I have no doubt some of this new round of stimulus will. And if it's as big as they talk about, this would be a very good making of a top for the market, just of the kind that the history books would enjoy. And we will have a few weeks of extra money and a few weeks of putting your last desperate chips into the game, and then an even more spectacular bust. The market is going to end up, as we know, where it is going to end up. And all the paper in the world will not change the level that is justified by the flow of dividends and earnings. That is, after all, the only thing you can end up eating is the flow of dividends. And sooner or later, the stock market will once again, boring, sell on the future flow of dividends. And that is not going to be changed materially by the size of the check we get in the next few weeks.
Jeremy, if you're right and we're on the cusp of the bursting of an epic bubble, is now the time to, as they say, sell everything?
I suspect selling everything would work out just fine. However, having said that, there are major discrepancies, as there were in 2000, between the US tech, which is overpriced the same as it was in 2000, and everything else. So the value stocks, the low growth stocks, if you prefer it, are about as cheap relative to the high growth stocks as they ever get. So they will not have the same pain, but they're still at risk to some degree, I suspect. The good news is that overseas, they have not had this same huge bull market and the same overpricing that we have had. And that of course, is a heaven-sent opportunity, because you can go out into the emerging markets and they are absolutely not that expensive, despite the ridiculous argument of comparisons with a overpriced bond market. They're simply not that bad anyway. And compared to the S&P, they're as cheap as they have ever been about. They've been this cheap 2 or 3 times, and each time it's worked out very well. So you can buy emerging markets, and you can look at the intersection of those two ideas, which is the low growth stocks or the value stocks within emerging, and they are handsomely priced. You should be able to make a really decent 10, 20-year return there. You will not make a handsome 10 or 20-year return from US growth stocks. There is, in the end, a simple arithmetic. The higher you bid up the price of an asset, the lower the long-term return you will get. There is nothing you can do to change that equation. Every day the market goes higher, you know only one thing with certainty, that the long-term return will be less than it was the day before.